Hey everyone, how's it going? Welcome to another video. Sorry it's been a while. Super excited for today's video. Today I want to focus on three companies, three examples, three option examples on how you can utilize options such as covered calls, cash secured puts, call credit spreads to collect monthly and weekly income. Today I'm going to highlight a couple examples on three companies. It's going to be Monday.com, Airbnb, and Twilio. So definitely stay tuned to the end if you want to see all the option examples. Hope you enjoy the video. If you find value at the end of the video, I would greatly appreciate if you could like and subscribe, comment down below. It really helps out the algorithm. And as you know, this is a newer channel, so all the support is much, much appreciated. Now, taking a look at Money.com is the first example. As you can see over the past month, it's gone up 20%, up to $153 and a peak of $170, all the way down from $113. So that's quite the run up. So those of you that don't know, Money.com is kind of a social tool platform company, provides internal transparency and collaboration tools, headquartered in Tel Aviv, founded in 2012 with a market cap of almost $7 billion, negative price to earnings ratio today. Let's take a look at the options for Monday.com. So a quick reminder, the first thing you want to do when you're selecting the options on Robinhood are selecting the expiration date that you want to trade. So personally, I like to go about a month out to 45 days out. So I guess in this example, we can go with 26 days. You want to capture theta decay with the longer time period when you are selling options. I personally prefer to sell options versus buy. So in the example today, knowing Monday.com's kind of been on an upward trajectory, it may be a little bit heated, a little bit too high. So, this example I'm going to show is a call credit spread. So for the first example, we'll go a little bit more aggressive and we'll just do pretty much an at the money call credit spread since, the stock has increased significantly lately. So I'm going to sell a call first. So let's say I sell the 155 call. That's the first leg of the option I'm going to do. So effectively, this is saying I'm going to collect $9.70 for this option, but you have a max loss that's unlimited because this is a naked covered call. So in theory, you want to protect yourself by buying one leg higher. So I've sold this leg from 155. I'm going to buy the 160. So now the credit I'm getting here is $1.50 per share in the option contract. So the option contract has 100 shares. So effectively, I'm going to get a credit of $150 today, max loss of $280, max profit $220. If you think about it in the lens of $1.50 collected today, you're putting up $500 of capital. That's about a 30% return. So that's pretty solid. But keep in mind that you're selling a call credit spread pretty much at the strike price of where the stock is currently. So you have to be extremely confident that the stock's not going to go higher. And in order to collect this and keep it in your account and nothing else to happen, you want this option to expire worthless. So come March 17th, you want Mondays.com stock price to be below 155. If it's above 155, you'll lose on this option trade. But if it's below, nothing will happen. The option will expire worthless, and you would have collected $150 today, and then in 17 or 26 days on March 17th, option expires worthless, nothing happens. So I'm going to close out of that example as that's a little bit more aggressive one. Let's go a little bit more conservative. And let's just go with selling a call for, 170. Let's just see what can happen here. So if I sell a call for 170, in theory, I collect $4.40, so $440. But again, I want to protect myself and not sell a naked call. So then I'm going to buy one leg higher. So as you can see, this one doesn't really make the most sense because, you're going to collect $10 today for exposing $500 of risk. So this to me is not a good example, not a good option, but I wanted to show you that super conservative approach. Keep in mind, these options examples are I'm doing this on the weekend, so the option chain could totally change during the week. So just keep that in mind. Now, if you're super confident Money.com is going to continue on this upward trajectory, you can sell put credit spreads. So I'll quickly do an example on a put credit spread before jumping into Airbnb and Twilio. So similar approach, it's just going to be on puts. So you're assuming the stock is going to continue upward. So you're going to sell puts below the current strike price. So let's go with 150. We're going to assume the stock's going to continue moving upward through March 17th. So I'm going to sell one put. But again, your max loss is effectively 14 grand because you're willing to be put the stock at 150 if it goes below. So to protect yourself and kind of make the trade much smaller from the amount of capital you're putting up, you're going to buy a put one leg lower, so 5 points lower. So I'm going to buy the 145 put. And now here, I'm going to collect $1.20 or $120 for this option. So today, if I execute this trade, I would have $120 deposited in my account. And then assuming Monday.com stock stays above 150, this option would expire worthless. Again, you have to keep in mind, what's your risk and reward profile? What kind of return are you looking for? And how conservative or aggressive do you want to be? Now, moving over to the second stock, Airbnb. I'm sure everybody knows Airbnb. It's been up almost 29%, 29 points over the past month, all the way below of about, 97 to a peak of 144. So pretty similar to Monday.com with that kind of big peak upwards. Market cap, 83 billion. Price to earnings of $47. And you can kind of see the ratings and earnings over the past few quarters. So I'll quickly show a call credit spread example here as well. I'm going to go about, 33 days out. I'll do March 24th for this example. I'm going to assume Airbnb's a little high right now. It may come down a little bit. Who knows with the market environment, the economy these days. So I'm going to go a little bit more conservative, and let's go with a 140. So I'm going to start with a 140. So for this call credit spread, the first leg I'm going to do is I'm going to sell a 140 call, and then I'm going to buy one leg higher. And what's interesting, you can buy options with strike prices at dollar increments on Airbnb. So it just varies on the company. But I'm going to go with the $5 spread because that's pretty standard. So here's a pretty decent return, $1.14, $114. I'm putting up $500 of collateral because effectively the delta between 140 and 145. So that's $500. So this is almost a 20-ish% return in 33 days. Really, really not bad at all. But again, you have to understand, what's your risk? What's your reward profile? Do you think Airbnb is going to continue upward? Do you think it's going to continue downward? Closing these out, I can quickly show a put credit spread as well on Airbnb. So first, similar to the call credit spread, you're going to sell a put. So I'm just switching the selection up here at the top. And then I'm going to look for a strike price. Let's assume Airbnb, may actually come down a little bit, but I still think over the long term in the next month, remain neutral or go up. So let's go with a 120 and let's just see what happens. So if I sell a put for 120, I have to protect myself. So I have to buy put one leg below. So if I buy a 115, let's see what the return is. So you get $88 in your account today. And then if Airbnb on March 24th doesn't go below 120, the options would expire worthless and you would keep and collect this $88 today. So that's not horrible. That's, 15-ish% return. And, in my opinion, a little bit more conservative. Yeah, it's 10, 12 points below where Airbnb is currently trading today. So again, it totally depends on your risk and reward profile, but this is another example you could use to kind of learn how to trade these call credit spreads and these put credit spreads. And moving over to Twilio, this is the last company I want to call. It's actually pretty crazy looking at these 1 month charts for all these companies. They've all gone up literally almost 28% in the past month, 27.14 for Twilio, up 15 points. Low of $51 in the past month, Holloway high, peak of, $78, peaked up here after earnings and it's come back down. But I think Twilio is an exciting company and long term looks like it has amazing growth trajectory. Current market cap is 13 billion. Twilio is more of a communication software, cloud-based platform. So great company in my opinion. I love looking at the option chain for Twilio. So happy to walk through this one today. Similarly, like the other companies, you want to select the strike price first. I'm going to go 33 days out, so March 24th for Twilio. And the first example I'm going to do is a call credit spread. So call credit spreads, like I've mentioned, are great for smaller accounts. So first, you're going to sell a call. And, you're assuming here Twilio is going to remain somewhat neutral and not jump up significantly. So let's go with a 80. Let's just see what happens. That's pretty conservative. And I'm going to buy call one leg higher. We'll see if this one even works and what the return will be. So in this example, you get a total credit of $53, so about a 10% return in 33 days. To me, for Twilio, I don't know if call credit spreads would be the best. Again, this is just an example, because of the potential trajectory and momentum Twilio has. Earnings are growing, revenue's growing, customer base is growing. So again, this is an example of really just how to do it. I'm going to look at a put credit spread actually for Twilio because I think I prefer doing a put credit spread on Twilio given the stock price movement over the past month and the earnings that just came out. I'm going to do a put credit spread on Twilio. Let's go for 65. So I'm going to sell a put as the first option. The next leg down, I have to buy. So I'm going to choose a 60. So here the spread is $5 again, the delta between these two contract strike prices. And the total credit that I'm going to get in my account today is $90 for doing this trade. And then come March 24th, if Twilio remains above $65, the option would expire worthless, the put credit spread would expire worthless, nothing would happen, and the $90 would stay in my account. It's already in my account technically the day that you trade this option. Again, this is roughly a little bit below 20% return because the $5 you're putting up is effectively $500 of collateral. So keep that in mind. That's kind of from a percentage return standpoint. What's actually interesting here, if I remove that option, you can choose a strike price that's not 5 points below. You could do one that's 1 point below. You're not going to get really any return there, but you can, have a few options here to choose from. You can go 2 points lower, collect $29 today. This is, $200 of collateral, so that's 15%, I guess, closer to return. So again, the strike price is just totally depends on your risk and reward profile, kind of what kind of spread you want, how large your account is. So these are things to consider. If you guys found value in the video, would be amazing and would really appreciate it if you could like and subscribe. Feel free to comment down below any other examples you want me to cover, any other stocks you want me to cover. Really looking forward to see the channel grow and getting your engagement in the future. Hope you have a great one.